delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
Welcome back to another episode of Stock Market Mentor. I'm joined by myself, Jacob Sr., and our wonderful Steve Moriarty. These intros are getting better and better, aren't they, mate? How are you going? You good?
I'm well. I'm rising up in the stakes. Wonderful, expert, guru.
Each week's going to get more cringy. Look, today's the probably one of the most exciting and controversial, in quotation marks, episode that we've got. It does link directly back to the episode of average versus geometric returns. But we might have a few pitchforks by the end of this outside our doors. So basically, we're covering why buy and hold, why rebalancing, what is the difference, is there time frames involved. We have many books and experts on why we should, and the market, the industry really tells us why we should just throw money in the market and let it sit.
Yeah.
Or diamond hands, as most people refer to these days. But what we're trying to debunk is you can actually be a little bit smarter about it and rebalance. So I might hand over to you, mate, too.
Yeah. It doesn't require a lot of work. One of the aspects, one of the sort of industry things is, and as you mentioned, this is probably the most controversial one, right? Time in the market versus time in the market. Oh, you can't time the market; it's impossible. You know, there's a lot of people who seem to trade stocks who do really well.
Millions of people,
and that's time in the market. So you know, it's not impossible. And again, a lot of it's predicated on the three themes. You know, the time you're in the market, the incentives for industry is to hold your money for longer. So therefore, it's just, you know, buy and hold favours them. So when you look at those aspects of it, the first thing you always want to do is say, well, what is my time frame for investing? You know, is it 10 years, 20 years, or 30 years? Because as we talked about in average returns, geometric returns, it varies considerably, right?
And it can change whilst within somebody's investing career. So they might start out saying, I'm going to invest for 30 years, but then have an absolute cracker over 10 years and just need to change it because their risk appetite changes.
Yeah, but also too, Jacob, their life circumstances changes. You know, you get children, you cut back on investing because you've got more different expenses. When you're in retirement, you got you got no money coming in, so you've got to have a different approach. And so this one is that you know, the optimal time to hold an investment. The argument is, like we talked about in average versus geometric returns, the answer is it depends.
Yeah.
Right? Because what are you, 28 or something?
29.
29.
I'll be 28 for this one, though.
Yeah. All right. Well, I'll be 50 even though I'm 60. But the point being, I'm in essence sort of retired, so the income situation is different. The long term is not, you know, for you, it's probably another 50 to 60 years. For me.
Yippee.
Sadly, it's probably going to be 20. So there's a whole range of differences there. So you first of all have to think about that. The industry argument is, everyone should buy and hold, and it just varies between your allocation between, you know, for example, stocks and bonds. And again, my argument is, well, hang on a second. If we know the market has, you know, the bull market and the bear market, why am I investing my money through a bear market when it's obvious that I'm not going to get a lot back? Even though, as we talked of average versus geometric, if you look at the earnings yield at the moment is quite low. Well, it's below the long-term average. So that's a dangerous time to have a lot of money in the market. But the buy and hold argument is, oh, well, you can't tell what's going to happen.
Just keep feeding it in and it'll be right.
Yeah, but that's okay for you because you're 29.
Well, it's not, though, because then in 10 years' time when I could have sat on my hands for 5 years,
the
long-term Well, to use CAPE ratio or the earnings yield, I could have had a much better yield.
Yes.
Over the next 5 years. So
and that's what this stuff. It always comes back to these sort of as the three themes, about the time and the incentives and the theory, and this idea constantly saying we don't know what the market's going to do is quite frankly bullshit.
Yeah.
Because we've got things like CAPE, earnings yield, which even if you didn't know what the market was going to do, if I said to you, Jacob, you're going to get 1%, you go, well, I'm obviously not going to be putting a lot of money in that.
Exactly.
Right? And that's what most people suffer, right? And again, when we talked in average versus geometric returns, if the mechanic says, listen, mate, this is the best way to run your car, you generally go, oh, okay, well, this guy knows what he's talking about. That's what I'll do. And what we're saying is, when they say to you, oh, Jacob, you just got to buy and hold, well, first of all, that's not the right way to do it. And secondly, the industry themselves don't do it, right? So if you go back 100 years, when you look at famous investors like Ben Graham or John Templeton and you read about them, they were always talking about macro stuff. Ben Graham was always saying, here's the value of the market. Right? No one talks about, well, I shouldn't say no one, but hardly any mainstream discussion is talked about in terms of what's the market valued at. Because the argument is, no, you don't worry about the market. You just buy quality companies.
Here's a graph. You can see over the last 100 years it goes up.
Yeah. And what's it go up by? Oh, average 8%, right? So
bullshit anyway.
Yeah. So that's why we're saying, if in the old days, Ben Graham and people like John Templeton and others, and even Warren Buffett, they understand that there are good times to be in the market and there's bad times to be in the market. And 2023, markets are really expensive. There's lots of volatility. There's a lot of issues. And for me, the big point is the valuation is high. Now, it could boom for another 6 or 12 months. Absolutely. I understand that. But I'm not investing for 6 or 12 months. And if you do a long-term return, even then you say, well, buy and hold doesn't make sense, right? You have to rebalance because, again, what we talked about in earlier episodes is that effect of volatility, right, and the sequence of returns. And as you mentioned before, you get a great bull market, but you don't lose 50% of the starting amount. You lose 50% of everything that you made. So if you made 300%, which is fairly common, 300 to 400% in a long series bull market, if you lose 50%, you don't lose 50%, you lose 200% of the 400, right? It gets cut in half. And that's how you get average returns. And our argument is from there is saying, well, hang on, if we didn't know what was going to happen, then buy and hold might be a good idea. But the reality is we know how markets, ebb and flow. And so therefore it's actually fairly simple. What you've got to do is, as you mentioned in the previous episode, you've just got to be patient to say, if you said to me, Steve, I'm only investing when the earnings yield is at 8. Anything below that, I'm not interested. You'd have periods where there were long stretches of time where the market goes nowhere. And we'll have that in the show notes. There's periods where, well, like I talked about with the Dow Jones. They go nowhere for 10, even 20 years, if my memory serves me correctly. The worst 20-year period was something like 2% returns. I mean, that's
inflation. You take inflation, you're going backwards.
Well, it's just miserable. But the industry keep this idea going of like, oh, you can't tell what's going to happen.
Well, they make it sound hard, and one thing that. Actually, not one thing. This comes up often in my friendship circles and people that I speak with about investing is they don't know how to do it. They're not interested in what it all looks like. It's all a bit too hard. And they've been told that buy and hold, they've been shown a graph or they've seen one online and it just goes up. So why not do that? And we'll dollar cost average in. And they're the people that I find hard to crack. I'm not sure if you've got any views on that because they actually just don't care. what I try to explain to them is you don't need to be an expert. You don't need to have a degree in finance to understand the common sense principles.
Yeah, this is what the whole, and I'd sort of say this every episode, this is what we're trying to get across to people. It's not that hard, right? You don't have to be a stock picker. You don't have to buy and hold, right? You don't need all those things. You can do simple things like index funds and rebalance, and you can do that by yourself, right? But again, what happens is you go to a, quote, expert and you believe that they're telling you the truth, right? So there's this one argument in buy and hold you hear all the time, right? And it's just bullshit. It's the 10 best days, right? Oh, Jacob, if you miss out on the 10 best days, your returns will be shit house, right? Then you look at it, and Meb Faber has done a paper on it that clearly shows the 10 best days are in the same basic, week or month as the 10 worst days. So in other words, you go down 10% in a day and you go up 10%. But what they do is the people, they grab the 10% up day and pull those ones out and go, oh, look at that, Jacob, terrible returns. But it's, for a start, it's stupid. Nobody can pick, the daily return. But the point he's making is that, you go down 10% and up 10%, as we discussed before, with the geometrics of it, you look at it and say, well, you're still actually behind, right? So this idea and what we talk about is, again, trying to say to people, you've got to look at it, you've got to look at these long-term returns, but there's also the point where, as we talk about, focus on not losing money, right? And it's really a smooth 5% is much better than a volatile 7, right? And again, that's the mathematics of it. So when you look at it like that, when you actually say, well, Steve, what's it look like without the big drawdowns, right? You look at it and say the returns are a lot better. Now, the argument could be, oh, well, hang on, mate, you just said you couldn't pick the 10 best days. Now you're talking about the big drawdowns. Yeah. But what I'm saying there is, but we know when the big drawdowns are probable. We don't know when the 10 best days are. And what you find is the 10 best days are in highly volatile periods, right? And we know high volatility eats away at returns. When do they happen? They happen in down markets, right? And so what we're saying is, well, if you listen to us, you want to avoid a down market. You wouldn't be in it in the first place. Or you wouldn't be in it in the first place. Or more importantly, or not importantly, but more realistically by saying, well, Jacob, don't have your $1 million in there. Yeah. Maybe have 100,000 in there. And it's painful because you get this high volatility, right? And the day that it does go up 10%, you think, oh, man, I should have been in the market. But you don't think the day before go, oh, thank Christ I wasn't in the market. Exactly. By the time when the washing machine is finished and you've got your cash that's sat in the bank ready to go again, you'll be thanking your lucky stars. Just an interesting point on, you brought up John Templeton and Ben Graham. I mean, they both argued that you should kind of adjust your allocation between stocks and bonds as the valuation changes. Yeah. Maybe let's touch on that slightly more. Ben Graham talks about it. There's a really, really great book called The Rediscovered Benjamin Graham, and I really recommend people read it. And the reason why is because, Warren Buffett, my favourite holding period's forever. Well, yeah, mine is too if I buy Apple. It's like, and what about if you buy a shit stock? Oh, my favourite holding period's like 3 days. But my point being, this idea, even from Buffett, of buy an index fund and, just sit there. And that's wrong, right? It's okay if you're worth, what's he worth? Over 100 billion. Yeah. Right? You can afford to sit there for the rest of your bloody life and not do anything. But if you're 29, well, that's not the case. You've got to be more active. Well, I mean, it shows in his early career that he was a lot more in and out of stocks. Absolutely. Anyway, it's just recently where he's obviously started to he relies more on dividends and massive different stock allocations and rebalancing over a long period. If you talk to Ben Graham, if you read Ben Graham in the book, The Rediscovered Benjamin Graham, what you see is in about 3 or 4 chapters, he constantly talks about the value of the market, right? And John Templeton said the same thing. Ben Graham, I think, said when bonds are yielding more than stocks, you should be up to your neck in bonds. Or, essentially saying, look, when the stock market's really crazy and it's really expensive, you should be buying bonds or buying an investment property or something where there's value. Right? And the idea of saying, oh, no, Steve, you just buy and hold is basically saying, oh, well, prices are relevant. And what I'm saying to people is, well, if prices are relevant, how do I get, what's the returns and blah, blah, blah. It doesn't matter. It's just buy and hold. Yeah. And again, as we said, Jacob, 8-10% annual average. And that's not the way it happens. You get plus 20 or you get, minus 3 or something.
There's a really interesting graph. I think it'll be in the podcast notes that shows the exact amount of times that somebody would land on the average return over 100 years or however it is, and it's about 4 times. Everything else is above or below.
And that's what we encourage people to do is rebalance their portfolio. Now, that's what the experts do. Right?
Well, I was going to say the fund managers change their allocations all the time. They tell everybody to give them your money and just put it in the market, but they actually change their asset allocation multiple times.
Well, they generally change it monthly. But the other thing is too, who do you think causes the market fluctuations?
Yeah, good point.
If it's a buy and hold, well, if everybody's buying and holding, then generally you should have low volatility.
There's no one to sell to.
Right, and there's no one to sell to. So that's why I'd say, if you look at the industry and you look at your superannuation fund, you can mimic that yourself, right? There's, and I do this often. There's basically 10 ETFs that you can say, all right, gold, REITs, the ASX, the US market, European market, emerging markets, and a couple of other ETFs. There's your superannuation fund, essentially, right? So, and then what you do is from there, you look at the asset allocation and the rebalancing, and you do that on valuation. The hard part for the industry is if their mandate is we have to be 90% invested at all times, they don't care if the market's really high. First of all, they can't do much about it. And secondly, the fee structure is, if I said to you, Jacob, I'm charging you 1 or 1.5%, and I've got you in cash, you're going, Steve, mate,
what are you doing?
What are you doing? Right? But that's the incentive for me is the more you make, the more I make as a fund manager. And again, it gets back to what we talked about with, everyone's trying to grab assets under management because that's the way, that's where the fee structure is really, really good.
And the time of the assets being under management ensures that I get a larger fee as well. So
yeah. It compounds.
Yeah.
Right. And that's the compounding's really great, but your fees compound, all the other charges compound.
Inflation compounds.
Yeah. Everything. And so that's why when we talked about the average return, you end up with 2%.
Yeah.
Right?
I think it's a really interesting point you brought up just before on almost mimicking your superannuation.
Yep.
And looking at the yield of each sector or ETF, for example. I think it begs the question, process is really important in this particular subject, buy and hold versus rebalancing. If you have a really simple process to follow, you understand when you need to look and what needs to happen when you realize there's a cheap sector or cheap ETF or an expensive sector or expensive ETF and what that rebalance process looks like.
Yep.
It might be worth briefly touching on that so people understand what a rebalancing process actually entails because it's not actually that difficult.
Yeah, that's a good point actually because people I've worked with, rebalancing is one that's a bit tricky, even though it's really what I think is really simple, right? But there's more than one step to it, right? And the other thing is this, here's the really tricky bit, your emotions come into play, right? After a really great 12 months, the last thing you want to do is sell, right? And take some profit, right?
Particularly if it's big time as well.
Absolutely. And the last thing you want to do when something's fallen is put more money into it, right? So let me run through the process. You can start out simply by saying, okay, let's say it's a average Cape, right? Let's say the Cape 17, right? And you say, righto, I've got $100. I'm going to put $50 into an ETF. Let's say it's VAS, right? Australian Vanguard shares. and I'm going to put $50 in cash, right? So you got 50 in the market and 50 in cash.
Yep.
Now, you come back, let's say 12 months later, and your $50 is gone to $60. So now you've got $60 and $50 in cash, right? So now you've got $110 overall. Now, if you say, Steve, I want to maintain my 50-50, that means you've got to have $55 in each pot.
Yep.
Well, I got 60 in the stock pot.
So take $5 off the table.
And put it into the cash pot. So the cash pot now goes from 50 to 55 and the stock pot goes from 60 to 55. So we're back at 50-50, right? So you continue to do that. Now, if you say, but Steve, the CAPE ratio's at 12, then I would say, all right, Jacob, we'll put $80 in to start with and $20 in cash. Now, the reason why is because we know that the valuation is really critical, right? Everyone likes buying things cheap, right? So if it's really cheap, you should have more money in it. Now, as the market rises, you can't continue to always have 80-20, right?
Move back to 60-40 or 50-50 again.
Yeah, because the valuation, it's like saying a punnet of strawberries is $1. Right, I'm going to buy 5 punnets. You come back in 6 months, they're now $5 a punnet. Well, you don't say to yourself, I'm going to buy 5 punnets, right? Because the value is different. And it's the same in the stock market. That's why macro valuations, in my mind, and even at the individual level, is really important, right? Is Apple a great stock? Yeah, but is it worth, at the moment 400? Well, no. Okay, well, valuation means something. So that, in terms of rebalancing, is you can do it mechanically by saying, doesn't matter what happens, I'm always going to be 70-30, right, in the market. Or you can say the market's really crazy, I'm going to switch from 70-30 to 30-70, right, which is what I do in one of my strategies.
I think I'm 90-10 now.
Yeah,
90% cash.
Right. Well, I'm
terrifying.
something like 40-60 with 60 in cash.
Yep.
But the point being, the rebalancing is really, really important, because if you understand the mathematics of it, that's where the money's made. Right. And I often say to people, it doesn't matter what asset you buy, if you've got a level of volatility there and you rebalance, you will make money out of the rebalancing. Right. And this is what's sort of talked about in what they call the Kelly criterion. Right. The secret sauce is the rebalancing. Right, that's where you take advantage of the volatility. Right, that's how the mathematics works.
Well, it not only compounds at a really consistent rate, something that is genuinely sustainable. It also means you cannot lose all of your cash.
Yes,
even if you're 80% invested.
Absolutely,
and you have a hard cap on 80% invested, and 80 in and 20 out. And it also means that it really does quieten your mind. You mentioned at the beginning there how it was really difficult to take money off the top when you've had a really good run. But then once you do and you understand the process, it becomes really simple and easy to do, because you know it's the process, and it's not that there's 20 more years of investing you've got to, depending on your age.
Yeah. Look, even once you understand the facts about the market or the realities of rebalancing, or you understand why buy and hold is not effective, it makes it a lot easier to be systematic, right? Because I know I'm going to sell this thing and the bloody thing's going to go up 20 or 30%. Yep, I know that. And I get that all the time. Right? I rebalance and the thing goes up, And what's the first thing I do? I'd have another 10 grand if I'd have left that money in there. But if it had gone down, I'd have gone, I'm a bloody genius for rebalancing, right? Yeah. So, and again, if you do that and stretch it out over the long term, what you see is you get better returns, right? That's what Warren Buffett does. He rebalances all the time because he understands the mathematics of it. And it's really, really simple. We talked about that in average versus geometric. Once you understand that and market valuation, you can narrow it down to really, really simple equation, if that's the right word, or a simple system, by saying, where am I in the market cycle? Now, that could be CAPE, right? Or it could be the earnings yield.
Yep.
That then says to you, that should dictate what your asset allocation is.
exactly.
right? And then the consequence of, like you said before, 80-20 is then saying, well, Steve, now the market's really crazy. I want to be 30-70. And it's like, okay, Jacob, now you got to rebalance.
I think it's important to say as well, rebalancing should be uncorrelated assets.
Yes.
You wouldn't rebalance two different stocks in the Dow, because if the Dow decides to absolutely eat a bag, then everything is going to go down together.
Yeah. This is the importance of cash that a lot of people don't understand, right? And the reason why is because you're making the assumption that you're missing out, right? And I see this all the time, and it has been for the last probably 5 years really hard, because you're looking at it going, there's this booming stock market, and you've got a portion of your money in cash. But what you don't realise is, again, it's the down periods that bugger your returns.
It determines the end result.
Yep. Everybody, the old story, don't mistake genius for a bull market, right? And everybody falls into it. We all think we picked the right stocks when, in fact, the S&P 500, 490 stocks went up and 10 went down. You could have picked anything, right? And it would have gone up, right? So that's what
it's skill versus luck, right?
Well, yeah, but it ties in again to that buy and hold idea, that you just ignore valuation. Oh, the market's expensive, but you can't tell when it's going to go down. I'm not interested in when it's going to go down. I'm interested in how far it's going to go down, right? And valuation tells you generally how far it's going to go down if you use CAPE for a 10-year period, right? Now, I don't know what it's going to do in the next 6 months, but I'm not investing for 6 months. And this is where it gets back to that time thing, right? Like you were saying, I talked to a guy in the COVID crisis, who lost 35% of his portfolio, right? And he had to go back to work. Because why? Because they had all his money in the market. Now, at that point, the CAPE ratio was 33 or 34, right? Which was basically saying, this is a really, really bad time to have a lot of money in the market.
Yeah.
You see, but if you don't understand these fundamental points, you're going to get suckered all the time into thinking, oh, Jacob, you're missing out because, you're holding cash, when the earnings yield is like miserable.
I think, just to start wrapping it up, the secret really is to investing is just understanding the market cycles or the fluctuations in the market over time. That is the biggest key point that we can say. Buy and hold is the industry standard because they want it to be.
Yes.
And it's easy to sell. But just some really basic concepts on rebalancing and understanding the market cycle can genuinely help someone over their investing career for 10, 20, 30, 40 years.
Yes.
So I would go and have a look at, generally go and have a look at where your allocation is now and go, okay, is this the right thing to be doing?
Absolutely.
Particularly with where we are in the market cycle at the moment, which is super overvalued. So
it's that thing where a lot of the time, again, and we'll talk about this in future episodes, but this idea that, oh, Jacob, you're 29, you should be in a growth fund. Right, because that's the best thing over the long term. You look at the long term, you go, no, it's not. Actually, it's not the best thing.
It's crap.
It all comes back to that, like you say, the market cycle and the valuation, right? Is the market really expensive? Yeah. Well, don't be an idiot and have lots of your money in the market.
Just wait.
Because, and again, we talk about the three themes. The incentive for the industry is to do that. That's not in your best interest. That's in the industry's best interest. And once you understand these simple concepts, the end of this series, we'll talk about strategies that you can use that use these concepts, and it's really, really simple. Even Warren Buffett talks about it all the time. How simple can you be is buy an index fund? Right? Yeah. That's it. Just,
nowadays, you just click a button and you're in.
Yeah, and so that's why we say it's not hard to do. The hard stuff's the emotional stuff. But if you're able to say, oh, yeah, I know this will happen because, I'm got that knowledge, it makes things so much easier. It's annoying because things will go up or things will go down, but that's the way it works.
Yeah.
Right?
I think it's it's a topic that we could probably go on about for about 1,000 hours. But if anyone has any questions that are listening, feel free to reach out. We're happy to answer them. We're really passionate about this particular topic because you can time the market. You don't have to pick the 10 best days or the 10 worst days. You can genuinely time it. But we'll leave it there for now. Steve, as always, thank you.
No problem.
It's been really good to chat and discuss this particular topic. So we'll leave it there.
See you next time.
Cheers.
Cheers.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.